Managing your portfolio is easy with FundReveal. You make the decisions. FundReveal does the heavy lifting. Basic service. FundReveal-Advisor web-based interactive report. FundReveal Portfolio Analyzer and Monitor. No opinions, views, or bets. Select funds that can optimize risk-return balance of your portfolio. Be close to the efficient frontier. Use objective data on current risk-return behavior and long-term tendency to maintain desired risk-return balance. Compare with different indices. Tune and rebalance regularly. Sell funds that have moved away from the frontier and buy more desirable funds. Our web report helps you in monitoring risk-return balance of your portfolio regularly. Rebalance and retune quarterly or earlier if needed. FundReveal Fund Finder. Find other desirable funds to add to your portfolio. Other FundReveal-Advisor-Services. FundReveal Premium Service. Monthly risk-return behavior report for your entire list of funds that are available from your broker. Automatically emailed to you with password protection. Sub-advisor service. Automated strategies if your clients want portions of their investment portfolios to be on autopilot. The account remains with you. We only do the back office work for you. How to use the FundReveal Advisor Report for optimizing and managing your portfolio. We will use fund symbol FCNTX for illustration. Click on FCNTX or its sector to see details. Pop-up shows details of FCNTX. 1. Symbol of fund, index, or market sector selected by you. 2. Sector or style of the selected item. 3. Name. 4. AUM, approximate assets under management in millions of dollars. 5. Fund family, or name of fund company, or index originator. FCNTX persistence PRA and PRB together are 65. That's good compared to other funds on the list. But its PRD is 20, indicating higher tendency to take higher risk than market and yet not be able to produce higher returns. This requires close monitoring. FCNTX is also showing a general tendency to dance all over the risk-return map. This suggests that the fund manager is not maintaining consistent risk-return behavior, not desirable for stable optimization. Over the last 2 rolling quarters, Q1 and Q2, FCNTX has not shown the worst D rating. Let's note this and continue with further analysis. For a quick view of how the different funds compare with FCNTX in the current time period, let's see their risk-return ratings. FCNTX behavior is rated as B, meaning high return but also high risk compared to market. This is better than IACBX, which is D. And if you are not looking only for safety, then FCNTX looks better than CAYAX, which has a current rating C. In the next step, we will look at absolute values of risk, return, and WCR for FCNTX and compare them with those of other funds in the list. FCNTX return is only slightly higher than that of S&P 500, and risk is also slightly higher, but its FCR is lower than that of S&P 500. Lower WCR is not a good indication. Other funds could provide better choices for your portfolio. In general, when a stock fund is very large, its portfolio tends to hold shares in almost all large, mid, and low capitalization stocks available in the market. Such funds tends to hug the S&P 500. If you want a portion of your portfolio to represent the entire market, then index funds that track S&P 500 or a market tracking ETF, such as SPI, might be better choices. Let's summarize what we have seen so far. XEVNX has tendency for balance between A and C. Its recent quarter's behavior has been A and A. good recently. Its current behavior is good. A, high return, lowest risk, and high WCR. It is the best of the list. CAYAX has tendency for balance towards C, low risk. Its recent quarters behavior has been C and A, good recently. Its current behavior is good. C, safe, low risk, and high WCR. It is good for safety, but not high return. PRLEX has tendency for D, worst behavior. It dances all over the map, but its recent quarters behavior has been B and C, good recently. Its current behavior is also good. A, high return, low risk, but it changes to worst behavior often. Needs frequent monitoring if selected. FCNTX with high D, worst behavior, has a tendency to dance all over the map, but its recent quarters behavior is B and C, good recently. Its current behavior is not good. WCR is lower than market. Although B, it hugs market. Index fund or SPI might be better alternatives. IACBX has tendency for B, but it also has very high tendency for D, worst behavior. Its recent quarters behavior is D and D, danger. Its current behavior is worst. D, low return, yet high risk. And WCR is negative. Data does not support its selection. Watch for future trends. For further details on persistence of FCNTX, click on any PR value for FCNTX to see a pop-up graph for its excess return, RE, and excess risk, RI, relative to S&P 500 over the last 20 rolling quarters. This pop-up graph is showing excess return, RE, and excess risk, RI, of FCNTX relative to S&P 500 over the last 20 rolling quarters. Risk and return for S&P 500 over same quarters are also shown for comparison. Q1 is the most recent rolling quarter, and Q20 the oldest. Bars are color-coded per risk-return ratings. A is green, B is blue, C is orange, and D is red. FCNTX had recent ratings of B, but its returns were only slightly higher. In some other quarters, its ratings were D. In general, ratings of D over multiple quarters indicate potential losses relative to market. FCNTX has excess risk of 3 over S&P 500 in the fourth rolling quarter, prior to current date. But FCNTX return is lower than S&P 500 by 11 in Q4. In the same quarter, Q4, S&P 500 return was only 6, and S&P 500 risk was at its usual value around 11. Considering details of FCNTX risk-return behavior, you can decide if you would like to keep the fund in your tentative selection list versus other available alternatives. Of course, you need more information to support your final portfolio optimization decision. You will find it later in the risk-return comparison graph and 3 other graphs. Let's select the funds and indices that we want to evaluate further and click on this tab. The cursor rollover box shows details of FCNTX. As seen in the results table, it has high PRD, and it dances all over the ratings map. Both are undesirable indications. To see FCNTX placement more closely, let's zoom in by sweeping the cursor and highlighting an area covering the FCNTX icon. Now, you see an expanded view that more clearly shows where FCNTX is placed on the risk-return graph. You can go back to full view by clicking on this Show All button. XEVNX is recently showing high return and low risk. Its PRD rating is also low, indicating that it does not seem to have a tendency for undesirable behavior of low return and high risk. PRLEX is also showing recent high return, but its risk is only slightly lower than S&P 500 and significantly higher than XEVNX. Its PRD is very high, indicating a high tendency to give low returns while taking high risk. Not desirable. Now, Let's see the S&P 500 rolling quarters graph to get a timely feel for the current risk-return trend of the market. Q1 is the most recent rolling quarter, and Q50 is the oldest quarter. Notice the downhill trend of S&P 500 return starting back in Q28 at the beginning of the crash year 2008. And notice the rapid increase in volatility around the same quarters. Rapidly decreasing returns and increasing volatility indicates high likelihood of sharp downturns or crashes. Time to find safe harbor funds. Recent market returns are moving within range, but volatility appears to be gradually and slightly trending upwards. Monitor over the next few months. This universe comparison graph for your selected time period is available below the risk-return comparison graph. Approximate efficient frontier. Notice that in the recent time period, half the fund world is playing safe with lower risk than market. But many funds are still taking high risk while producing lower returns. Are these fund managers struggling to figure out their strategies in the current market? You can also select prior time periods to study past market events and changes in the fund universe behavior. In 2007, many funds were taking high risk, and some were taking very high risk, but they were all producing high returns. Happy times! Yet some funds were operating at lower risk levels. In 2008, the general rule of thumb, high returns for high risk, broke down. Perhaps the economy-wide crash affected both the bond and stock markets. During the crash year, the very high-risk funds were unprepared. Their returns were not only highly negative, but were also far less than the market. Yet they continued to operate at high risk. The crash did not affect the low-risk takers as much as the high-risk takers. Most had returns better than the market, although negative. Some low-risk funds actually had positive returns in the crash year. Let's look at 2001 to 2002, the period of the dot-com bubble and its burst. During the bubble year of 2001, the market returns were already negative, with relatively high risk. Very high risk, tech funds were being showcased, and dot-com non-believers were being invited to join the ride or lose the bull market opportunity. But even low-risk funds were giving high positive returns. Then, in 2002, as the dot-com bubble burst, market volatility increased further, and returns dropped precipitously. Returns of most high-risk funds became negative and also dropped precipitously. While returns of low-risk funds also became negative, they remained better than the market, and some very low-risk funds actually gave positive returns. Now let's go back to the results table and select FCNTX and XEVNX, the finance sector fund that we had identified earlier, for further evaluation. And then click on the Fund Risk Return Trends tab. The Fund Risk Return Trends graph shows the risk and return values for the selected funds. The trends for S&P 500 are shown by red lines. S&P 500 returns have ranged between 0 to 40 over the last several quarters without any clear trend. S&P 500 risk, volatility of daily returns, is showing a slightly increasing trend, yet not an alarming indication. XEVNX has generally shown higher returns than S&P 500, while XEVNX risk has been lower than S&P 500. In comparison, FCNTX return has been hugging close to S&P 500. And FCNTX risk, too, has been close to S&P 500. Indications of a market hugger. Now, let's do some housekeeping. Click on this button to save a PDF copy of the results table. This message box appears. You can either open the PDF document or save it in a folder on your PC. If you had opened the document, this PDF copy of the results table would be seen. You can save as or save copy through the main file function of your browser or through the PDF toolbar. You can also download the results table in Excel. Just click on this button. A message box appears. you can save the Excel file to a folder on your PC. You can format, sort data, or edit this Excel file as you wish. It's now saved in a folder on your PC. As another housekeeping task, you can select funds that you decided to keep in your portfolio shortlist, and then click on this button to save the selected list to your FundReveal-Advisor account. Enter a name for your portfolio in this box. Click OK to save it to your FundReveal-Advisor account for future use.